So before we begin, we're going to actually go through what we set as your weekend homework. We basically cranked out 3 sections of the chapter on Friday, and these are the supplemental end of chapter activities that went with them. In the book, I'm on page 505. In section 2, we talked about how some assets deplete. In section 3, we talked about how the intangible assets either amortize or don't. Amortization is based on if they have a definite life. If they have an indefinite life, they do not lose value. And finally, the last one is, how does this all look on a financial statement, specifically from an analytical perspective? What's the asset turnover and how easy is it? It's very easy. So let's take a look at 505, exercise 1010. It looks like we are buying this $65,000 piece of equipment. No, that's not the right one. Exercise 11, excuse me. On July 1st, so halfway through the year, we invested $720,000 in a coal mine, hoping to get 900,000 tons out of it. And they're asking you to prepare the journal entry for depletion expense for year 2014. Is it a full year? No, it's not. So we will have to take it times, Actually, this is like units of activity. Never mind, it doesn't matter if we had it a full year. We just know that we extracted 100,000, I'm assuming tons, yes, that year. How did we get at the 80 cents a ton? I would hope they showed us that. Looking for that 720,000 estimated units out of there, 90,000 tons. When you divide, you'll get 80 cents a ton. So it didn't matter that we purchased it halfway through the year because of it's kind of like units of activity. How much did we actually take out? Do you guys have questions on that one at all? The cost pertaining to the unsold units, what is this even about? Assume that 100,000 tons were ore were mined, but only 80,000 were sold. How are the costs applicable to the 20,000 unsold reported? You would take that so we took out 100,000 tons, but we only sold 80 or 20? 20 unsold. How would we report that? The costs pertaining to the unsold units are reported in current assets as part of inventory. I don't think you're going to see that heart of stuff on the exams. I know that because I took them this morning. They're just saying, we have this 100,000 out, we've only sold 80. What about that left over 20? That's now like inventory. You're not going to see stuff like that on the test. Next one, 1012. We had a couple transactions pertaining to 2014, a January and a May. We purchased a small company and recorded goodwill of 150,000. Its useful life is indefinite. You will see goodwill not lose value, because they're asking us then to make adjusting entries wherever amortization is needed. You're not going to have any amortization happen on goodwill. I should have done that different, sorry. We're not going to amortize goodwill because it has an indefinite life. As far as the other one, we purchased a patent at $75,000, hoping to use it for 5 years with a legal life of 20 years. Okay, this does matter when we purchased it. It looks like we bought it on May 1, so May through December is 8 of 12 months. How much is it amortizing that year? You take it divided, so the value divided by the years. But remember, we didn't have it a full year, so it didn't amortize the 75 divided by 5. It only amortized the 8 of 12 months that we used it. Remember, you don't see accumulated depreciation pile up in intangibles. You see accumulated depreciation, you see accumulated depletion. Remember on this one, the intangible asset just loses value while the expense goes up. You guys remember talking about that last week? You might argue like, okay, a 20-year patent, why are we only going to have it for 5 years? That's a little bit weird. We could go back in the book and read, but they're telling you straight up the useful life's 5. What can I answer on that one? Okay. The 1013. Gill Company organized in 2014 has the following transactions related to intangible assets, and it looks like there are 4 of them. We purchased a patent. You see patent go up, cash go down. Remember, patent is an intangible asset, but you got to use an asset to gain another one. Goodwill was purchased. You'll see goodwill go up and cash go down. Part of the entry to record purchase of another company. Yeah, we're good there. Goodwill is such a tough one. You know, it's just like when Superior purchased Hancock Concrete. Who decides that's the value of that goodwill? Someone does. And it's just that corporate culture having a dollar amount placed on it. A 10-year franchise. Remember, some franchises have a definite life. According to this one, it's a 10-year. Okay. Some franchises have an indefinite life. And then, of course, they don't amortize. But this is just the acquisition or getting these different assets. Research and development costs, it's called R&D expense, and using cash to do that. So as you're coming up with a patent or as you're training, as you're developing, say, a new product prototype, it's called a research and development expense, or I'd be okay with R&D expense whenever you're writing it. You're putting money down to build up something, whether it's a new product or trying to decide if you are going to buy another company. Then they ask you to prepare the entries to buy these intangibles. All costs were cash, but then make the adjusting entries, recording any necessary amortization. They show you how they got all the numbers. We bought 4 things. We bought a patent, we bought a company, we bought a franchise, and we researched and developed. Why are we only seeing patents and franchises down here? Does goodwill lose value? No. This research and development expense is already expensed out, so we're not going to amortize it again. So they show you how they got the math there for it. But you basically take the $595,000 patent and divide it over its 7-year life to figure out 1 year. And then you take your franchise, divide it by 10, but notice when you purchased that, you had it only 6 to 12 months. So you see each of the assets lose just a little bit of value with the amortization up. Now, if you would have done 2 transactions there, amortization expense for the patent and then amortization expense for the franchise, I would have been okay with that. They ask you to show what it would look like, I think, on all the ending balances. I'm going to be honest, we're running out of time, so I'm going to keep going. The last one asks you to take a peek at the asset turnover, which again, asset turnover is net sales divided by average assets. So the beginning plus the ending divided by 2. 2.5 times. Again, what does that mean? What does the asset turnover mean? It tells us how many dollars of sales a company generates for each dollar invested. So this is quite a bit. Let's roll into the problems. And I'm sorry to rush through that. Again, like I mentioned, you can stop in anytime if you want clarification on things. I think you're going to find the most gratification when you take the practice test beginning tomorrow. All right, so and I really like some of the problems. Some of them are so-so, but let's get rolling. I hope you can see okay. Can you guys see? All right. You must have this. Do you have this? Woo, good. Okay, these two are plant assets. Okay, we own them. They are going to depreciate. Notice it doesn't say timber, or it doesn't say patent. Okay, taking a peek. Cost of filling and grading the land. Plus 4,000. And if you'd like to add a little plus, might not be a bad idea. Remember, when we decide land, building, or other, it's getting it ready to do what its intended use. Okay. Number 2, full payment to a building contractor. If we are going to construct a building, that's the building contractor. It will make the value of the building go up. Real estate taxes on land paid for the current year. Just like putting gas into an equipment. It's a recurring cost of having that asset. The asset in this case is our land, and if we paid taxes on it for the current year, you'll see property tax expense go up, not necessarily the value of the land go up. The next one is tricky. Cost of real estate purchased as a plant site. The land was $100,000, the building was $45,000. Any idea where that one's going to go? Let's use that corner of Highway 59 and 28 as you're heading out of town, the big four-way. And there's that big site, I believe it used to be something to do with Westmore. Do you know what I'm talking about, that big site? Okay. So if I go by that site and I'm going to get rid of those buildings and I'm going to have a plant site there for something. It's land, not buildings. I might scrap out the buildings and try to have a little bit of salvage value on those and sell the scrapped parts. But I'm buying that piece of land. It might have a building on it, but I don't want the building. I'm going to use that as a plant site for my business. Number 5, excavation costs for a new building. So I'm going to dig in the land and dig a basement for my building. That's a building. 6, architect fees on building plans. Some of them are very easy in the descriptor it tells you. Let's take a peek at the next one. Accrued real estate taxes paid at the time of purchasing the real estate. Am I behind one? No, I'm not. Accrued real estate taxes paid at the time of purchase of real estate. That means you're buying this chunk of land and you have to get all of the taxes up to date before the bank is going to give you the loan. And you need to get that updated before they're going to give you that land. Number 8, cost of a parking lot and a driveway. Is that land or building? Trick question. Neither. Land improvements. Cost of demoing a building to make the land suitable for construction. Why is that not building? We're demoing a building to build another building. But what did they say? Demoing the building to make the land suitable for constructing a new building. Do you think we can maybe scrap out a little bit of that old building and offset the cost? Yes. So now they're saying, okay, we've got land, we've got buildings, we've got other. Look at number 10. Proceeds from salvage of demoed building. Okay, these are assets. If we make money on them, it's like a revenue, right? You're actually going to subtract it out from the value of the land. Think of this like contra revenue because these all have debit balances, and down here this is a credit because it's like revenue. So it presented this way, it looks really weird. When we were doing the exercises, it'd say we purchased a building or land and it had an old warehouse on it, minus what we made from that salvage sale. So then that's why that's a minus, because it's offsetting basically the excavating cost of dozing that building. So then they say, all right, what's our land and what's our building value by the time we've gotten this whole operation done? And it shows the two. What can I answer on that? You guys ready to do all this? I hope you can see. I hope you can see the board because we are going to do the different rounds of depreciation. The book likes it this way. I like it this way. Just because this is the more teachable, like you understand where all the numbers come instead of just, what? So although the book gives you bus 1, bus 2, bus 3, years 2013, 14, I would prefer you do a workbook or a notebook page just because then I can show you. If you could get by with doing it there and know where your numbers come, great. For the test, great. But I want to lengthen it out. So here we go. What are we buying? We are buying buses, if I remember right. So down at the bottom of page 506, in recent years, Avery Transport purchased 3 used buses because frequent turnover in the accounting department, a different accountant, yeah. Okay, so go to page 507. Bus 1, bus 2, bus 3, they show us how much we paid for them on their acquisition dates, their salvage value, their useful years, and the type of depreciation. Okay. Then they go into a little bit more, like for the double declining balance, units of activity, here's how many miles were expected, here's how many miles were actually done. A, compute the amount of accumulated depreciation, so the pile, on each bus at the end of 2014. So here we go. I'm going to write really big here and then erase for everyone. So what I'd like you to do is bus 1. That is the bus that's using the straight line rate. or the straight line depreciation. This would be one that we calculate based on the depreciable cost, so what we bought it for minus the salvage value. And it's also important to note we bought it on 1/1 of 2012. They want us to show what happened in 2012, 2013, all the way through 2014. Okay? Let's do a little bit of math. Remember, straight line rate, we take 100% divided by its useful years. How many years are we going to use this thing? 5. So our straight line rate is 20%. We bought the thing for 96. Its salvage value is 6. So those are players in this. So we're going to take 96 minus its salvage value to be a depreciable cost of 90. So now we're set up to do what we're supposed to do. In 2012, are we going to take 96 at 20% or 90 at 20%? 90. $90,000 times our single line depreciation rate. In 2012, that first bus had a depreciation expense of $18,000. If we had to stop and journalize, we would say depreciation expense, 18 grand. Accumulated depreciation, also 18 grand. Pile is going to continue to grow. Nowhere on your workbook does it have a pile, but I like the pile because you can visually see it growing. They want us to go out through 14. So let's do 2013. Still the depreciable cost of 90 grand, still the 20% rate, still $18,000, but now our pile has grown to another 18 grand. And lucky for us, we bought this on 1/1, so we don't have to worry about times a half or partial year. Whew. On to the next year. 2014, still that depreciable cost of 90 grand. Still the 20% straight line rate. Still another $18,000. It's depreciating at a straight line. Every year it's 18,000. What the book is asking us to do is figure out the value of our pile. 18 plus 18 plus 18 is, our accumulated depreciation pile has grown to $54,000. We also could stop and say, well, what's it depreciated each year and what has our pile grown to? Any questions? It's that easy. It's just I like my version better. Should we move on to the next bus? Bus 2. What depreciation method are we using on bus 2 according to what you see in the book? Double declining. Okay. Double declining does not care about the depreciable cost. Doesn't matter. We do need to figure out single rate to get to our double rate. Our single rate would have been on this bus 100% divided by how many useful years is this bus going to be? Now notice we're going to a completely different bus. 4. So our single rate would have been 25%, but we're going to, of course, double that to be 50%. would like to erase just so I've got some more room. Go ahead and keep yours there. Okay. This thing was also purchased on 1/1 of 2012. Yay, not a partial year. They're going to have us do it in, okay, what if we would have bought this bus midway? We'll do that right away. All right, so in 2012, are we doing 96 or 90? 96, thank you. Remember, it's not the depreciable cost. Oh, that's right. I did that this morning too. Whew, I did a whole problem with, I'm like, wait a minute, why are my numbers not working? Different bus. That's what happens when I do this at 5:30 in the morning. 100,000, 110,000, excuse me, right? They're kind of dirty though that they list the salvage value on it, but that's just what happens. So you gotta be careful. 110,000, I'm on the right bus, right? It's going to lose 50% of its value. Down to 55,000. Now that is the depreciation expense for the year. The accumulated depreciation pile is also going to grow each year. In the first year, it's an addition of 55,000. Now, before I can move on to 2013, what do I have to do? I have to take that 110 minus what it depreciated by, so it'll start 2015 at a lower value. You got to just remember, double declining is just different. They calculate the stuff different. Okay, it's still going to have a 50% devaluation, equaling 27,500. I'm also going to get that added to the depreciation pile because now that depreciation pile is really growing. Before I can go on to 2014, I have to stop and say, okay, this $55,000 bus now lost another 27.5, and in 2014 it's, oh, I always forget that 50% is so easy. I just look at it like, what should that be? Times another 50%. 13,750. I got to get that added over here to the accumulated depreciation pile, and we're going to try to figure out what the pile is valued at. Now, you see a huge jump right away. In the first year, it lost 55,000, then not quite as much, then not quite as much. Okay, because remember, double declining shoots way down and then kind of plateaus off. So our amount in over the course of 3 years, its accumulated depreciation pile is up to 96,250. I want to quickly do part B. Okay, instead of moving on to bus 3, do you see where it says instructions and part A says compute the amount of accumulated depreciation on each bus? But part B says if bus 2 was purchased on April 1st, what would it look like instead? Can we do that right now since we're talking about bus 2? Okay. You have all your facts and figures up there still. I don't. So what they're saying, this is part A, that we bought it on 1/1/12. Part B of the problem saying, hey, what if we bought this on April 1st, 2012 instead? Tell me what it would look like. Can we run the numbers? We already know where we got the 50% double declining rate, right? I don't have to rewrite all that again. So they're saying, okay, in 2012, April 1, that is, we still have this $110,000 bus times the 50% double declining rate. We know that's 55,000. We calculated that once, but they're saying, okay, what if we didn't buy this at the beginning of the year like we did in A? What if we bought it on April 1st? If we bought something on April 1st and we are showing what its value is for the whole year, how many months did we have it if we bought it on April 1? Did you say 9? Okay. Because we had it all of April, all of May, all of June, all the way through December. Because they're asking you to figure out what's it worth at the end of the year. Okay, so at the end of year 2012, the thing was at 41,250 instead of 55 because we had it 9 of 12 months. We still, before we'd go on to 2013, we'd still take this number minus what we bought it for. To begin its second year, it's valued at 68,750 times the 50%. Do we have to take it times a partial year? No, because in 2013 we owned it the whole year. We just bought it halfway or midway through 2012. So at the end of 2013, it's 34,375. That's the only two answers Part B was looking for. They didn't care about accumulated depreciation. They just wanted to know, exact words were, if bus 2 were purchased on April 1 instead of January 1, what is the depreciation expense for the bus in 2012 and 2013? They didn't even want us to do through 14. They wanted us to just stop there. Cool. Let's do the third bus. Bus 3, I'm assuming it's units. When we buy this bus, we purchased, we purchased it on January 1st of 2013, and this is a depreciable cost type of depreciation. So this time this thing is 92 grand at purchase time. 92,000 minus the 8 that we're going to get out of salvage value. We're looking at a depreciable cost of 84,000. Here we go. The other two buses we bought at the beginning of 2012. This one begins at 2013, so we only have to do 2 years because they're only asking us to go out 2 years. Remember, this one is based on how many cents or dollars it is per mile. Well, we have to figure that out. We haven't done that yet. So we're going to take that 84,000 divided by the estimated miles that we're going to drive it. Remember, it wasn't 92. This is all based on depreciable cost. So the 84 is the depreciable cost, factoring in salvage value. 84,000, the depreciable cost, divided by the estimate of how many miles we're going to drive this thing. We're looking at 70 cents of depreciation for every mile we drive it. So in 2013, how many miles did we actually drive this thing? It would say it in the book. It would say it in the little bio in the book. I will tell you that we put on 24,000 times 70 cents. In that first year, it depreciated, or the depreciation expense was 16,800. If this was the depreciation expense, this is the accumulated depreciation pile. in 2014, which is all that the book is asking us to go through, we put on 34,000 miles. It depreciates at 70 cents a mile. The depreciation expense for that year was $23,800. Add that to our pile, which now equals 40,600. Had we bought this thing on April 1st, would it have mattered? No, because units of activity are units of activity. How much did you drive the thing? Who cares if you owned it for 3 months, 9 months, or a year? Okay. How do you feel about all that? Taylor. It's just part of how double declining is calculated. I wish I could go back, but I erased all my stuff. The reality is you don't use the depreciable cost on that one. Okay, hold that thought. You end up subtracting the year-end value. You know, you take what you buy it for minus what did it depreciate by, and then before you go on to that next year, you've devalued the thing. It's just that they don't care about depreciable costs. They care about really how much did it go down by. So you just have to remember that double declining does not care about salvage value. Okay, let's get a plan here. I'm going to do this on the recording. We have a couple more to do. We have problem 6 and problem 9. For homework, just do what we did for the part B. Then when you're here tomorrow, we'll do A together, and then you'll quickly do B on your own. So for your homework, just do the B version of what we did together in the A version. Does that sound okay? Had I not had a technical glitch this morning, we would have finished, but life happens. So your homework, I'll say it one more time. Problem 10.1b and 10.2b. Okay? Have an excellent day.